Have you bought a residential property or are in the middle of refinancing an existing mortgage and are trying to choose between a redraw only loan with their low interest rates or an offset account that has easier access to your savings? Knowing the right time to use an offset account or a redraw only account can potentially save you over $250,000 in interest costs on an average loan over a 30-year term, or it can help you pay it off 10 years earlier. In this video, I'm going to demonstrate a number of examples of when is the right time to choose a redraw only loan or an offset loan on your property purchase or loan refinance. Welcome to another video with Money with Dan. If you're interested in watching more videos that share ideas on saving money, investing and growing your wealth, then remember to press the subscribe button and select to receive notifications. Also, if you'd like to see more videos like this from me, then please also hit the like button to let me know. Mortgages with offset accounts in Australia comprise about 45% of the total value of residential mortgage debt, according to an APRA study in 2019. So there must be a valid reason to choose an offset account instead of a redraw only account, despite the obvious difference in interest rate, or is there? If you use the mortgage rate comparison website, you would have noticed that all of the cheap home loan rates with variable interest rates are from the smaller banks or non-bank lenders that don't have offset accounts. You may have also noticed that the difference in interest rates for a home loan with an offset account and one without one at the same bank could be more than 1%, especially at all the big four banks. Offset accounts also have high annual fixed rates of $395 that most banks will charge you on top of interest, while a redraw only loan usually has none. So why do people still use an offset account? Well, I'm going to show you with real examples when they are good to use and when they are not good to use. But first, a quick disclaimer. It is important to note here that the information in this video is for general information and entertainment purposes only, and is not a replacement for professional advice. Money with Dan is not a financial advisor. You should consider seeking independent legal, financial, taxation, or other advice to check how the information in this video relates to your unique circumstances. Now that is said, an offset account is simply a normal transaction account that you pay your normal bills with and have your salary deposited into, and also have a debit card linked to it. The balance in an offset account is also guaranteed by the Australian government up to $250,000 per bank. The main difference with a normal transaction account and an offset account is that instead of being paid a small amount of interest income, you get to save interest on your loan at your very high mortgage interest rate, which can be as high as 3 to 4% more than a savings account at any point in time. Also, any savings made from an offset account is also not taxable income, so you can save on tax as well. However, the major benefit of an offset account is that it is your money, not the bank's money, and you can access it anytime you like for any reason whatsoever. On the other hand, redraw only accounts allow you to draw down some of the money from your extra repayments you have made above your minimum loan repayments compared to your remaining loan term. You see, with a redraw account, it's not really your money, as you are paid down the loan quicker than what is required by the bank. So as you pay down your redraw only loan, so too does the amount you can redraw out of your loan, depending on how your bank calculates your redraw facility. Also, with a redraw account, you will need a separate transaction account to pay bills from and have your income deposited into, unlike an offset account. In this table here, I have summarized the difference of the standard variable interest rates charged using a sample of the big four banks, one non-bank lender and one medium-sized bank. The loan rates are the advertised rates as of the 18th of May 2021. Now at this point it is important to note that fixed interest loan rates allow very minimal extra loan repayments, if any at all, and I'll only be focusing on variable interest rate loans in all of my comparisons. Here you can see the advertised interest rates of the big four banks have significantly higher rates for their offset loan option than the non-bank lender, ME Bank, and the medium-sized lender, Macquarie Bank. The only exception is ANZ, which is currently less than ME Bank. In this table, when I compare each bank's offset account with their own redraw only option, you can see they all charge a markup with their offset, except for Macquarie Bank. Overall, you can see the biggest difference is a huge 1.16% with the Commonwealth Bank offset account compared to its redraw only option, while Macquarie Bank had no difference. While the average difference across the sample of loans is 0.63%. Although Macquarie Bank has no interest rate difference between its offset and redraw only product, Macquarie Bank's redraw only option is not the lowest, with Westpac's redraw only option having an interest rate at 2.29%. Also, the annual fees apply only to offset accounts, and they have a hefty $395 in this sample, except for Macquarie Bank, which has a lower fee at $248 per year. The banks do have a lot of discretion to change the advertised interest rate to be lower if they want to, especially if they are eager to sign you up and stop you from going to a cheaper competitor. Usually, to get a lower interest rate, the banks will take into consideration a number of factors, which can include, among other things, how large your deposit is, the loan to value ratio or LVR, your credit rating, your ability to service the loan, and the type of loan, such as a first home, a refinance, a construction loan, or an extra loan. But even if you did get a better rate than the advertised rate for a loan with an offset account, it is likely that the redraw only loan will also be lower too, in the same proportion, for the very same reasons. This means there is likely to be a constant price premium for having an offset account versus a redraw only option, which has been my experience for the past 2 decades. Now, after seeing the previous table, you may be thinking that the redraw option is the clear choice. Or perhaps you're thinking the Macquarie Bank offset account is. However, that really depends on your own circumstances. Often people will tell you an offset gives you the flexibility without explaining further on what that means or how much it costs. I will now explain further on flexibility, what it means, and what is the break-even point before a redraw only loan becomes the better option for you. The important circumstances to consider for whether you need an offset account are: do you plan on making significant extra repayments against the loan to pay it off fast, but still want the security of accessing those large amounts of repayments under any circumstance? Is this property going to be ever used for an investment property at some point in the future? Do you plan on keeping an emergency fund of cash in a separate savings account, or as an extra repayment against the loan to reduce the interest expense, and need access to those funds under any circumstance? The first reason for having an offset account might be for tax reasons, and whether you intend on changing the use of the property to a rental property. If I had plans not to live in the property as my main residence forever, but plan on renting it out and living elsewhere, then I would consider an offset account to put any extra repayments in there instead of a redraw only loan. A common scenario is a first home buyer who starts off with a very small property, which they know one day they will outgrow and will want to trade up to something bigger, but plan to keep the smaller property already owned as a rental property while using the balance in the offset account as a deposit on the next home. Now, if I did withdraw my offset account balance for a deposit for a new home, it is unlikely to impact the amount of a tax deduction that I could potentially claim if the current property becomes a rental property when I move out. Now, if I had a redraw only account and I had made extra repayments into the redraw in this circumstance, then my tax deduction on the interest expense may be limited to the amount on the remaining loan balance before I took out any extra loan repayments for the deposit. The tax implications and benefits could vary significantly depending on your circumstances, and expert tax advice is highly recommended. This then brings us to the next important reason for using an offset account, which is the ease at which you can access your extra loan repayments. If you want unlimited access to your loan repayment, then a redraw only loan usually has more limitations on how much you can access and when. This is usually at the discretion of the bank, allowing you access to those funds. Remember, the redraw is not a transaction account, and you need to be familiar with your loan contract to understand what limitations you will have at some point in the future. For instance, on the 4th of May 2020, ME Bank took away money from redraw accounts at their discretion, which was right at the middle of an economic crisis caused by the pandemic. If you lost your job and were depending on accessing your emergency fund in your redraw account, then you may have faced uncertainty or challenges. If we had a more prolonged crisis, this result could have been more widespread across other banks with redraw only options. If you need certainty of accessing funds whenever you want, then a redraw option is not really the best place, as you don't have the same controls as money in a transaction or savings account. So if you want more certainty with an emergency fund, then you may be better off putting it into a separate savings account to have better control in times of an economic uncertainty. That way you'll be able to get the low interest rates from a redraw only, but still be able to access your money. However, if you did use a savings savings account, they always pay a lot less interest income than the mortgage interest rate expense, by about 1 to 2% normally. The best interest rate for a savings account I could find on Rate City was 1.2% at my state bank. Also keep in mind any interest income will be taxed at your marginal tax rate, so the return on investment in your savings account will be even less money after tax. Now, if we consider that your redraw account will not have your emergency fund because of the access reason, then the lower rate of a redraw account seems less desirable compared to the return on money held in an offset account. However, the benefit of having money in an offset account with higher interest rates really depends on how much you plan on keeping in your offset account and for how long you want to keep it there. In this table, you can see the interest cost on a redraw only loan for the first 12 months. This calculation assumes the loan is interest-free and there have been no repayments to keep things simple. I have also calculated the interest on a starting balance of $478,000, which was the average new loan balance in January 2021, according to the Australian Bureau of Statistics. I have also added the interest income you would earn after a tax on a very generous emergency fund balance of $50,000 in a separate savings account. I have subtracted this interest cost to come up with a net interest cost in this column on the right-hand side. Next, I have added the total interest cost for an offset account, assuming no money is held in the offset account. Clearly, the much higher interest cost shows that this is a terrible option with these assumptions, and you would be better off with a redraw only. But how much money would you need to have in your offset account to make up for the difference in the higher interest rate you are being charged compared to a redraw account with an emergency account held in a savings account instead of the redraw account? Well, quite a lot in fact. If I add these two extra columns to the table, you can see in the first column I have shown the amount that is required to be in the offset account to at least lower your interest rate to match the cost in the redraw only account. As you can see, to cover the large variance of interest between an offset and a redraw facility, you would need to have up to $171,000 for Westpac or $166,000 for Commonwealth. Even Macquarie Bank, which charges only an extra bank fee to have an offset account, requires you to have $29,000 to cover those fixed costs alone compared to its redraw only option. So if you want access to your cash and want to save interest on your home loan, then you'll need to have a large sum of money in your offset account to simply break even. If you don't plan on keeping this much money in the offset account, then you are likely to be paying way too much in interest, and I suggest that you consider your options. Now, if you want to learn more about managing your money better, then check out the links to my videos on the screen right now.